Okay, hello everyone. My name is Mark Hodge, and I am head coach at Rockwell Trading. I've been actively trading for just over 10 years, and just a little bit about myself. I first got started as a broker assistant. Let's put it that way for the stock market here in the United States. I was very interested in what happens in the markets and the potential to make money in the markets. Got started with a brokerage and later became a financial advisor. But during that time, I discovered that I really wasn't interested in telling people what they should invest in, but instead in actively trading myself. So I got started trading stocks actually in the late 90s in the dot-gone era when it was very easy to make money. And then as many people discovered, if you were trading stocks back then, you needed to be a little bit more sophisticated to actually make money in different market conditions. And so a lot of people struggled. Right around that time, I got into options trading. I did very well trading equity options. Now, even though options went well for me, I discovered that I was definitely prone to short-term trading. I just had that mentality and mindset where I wanted to be in the market, take advantage of opportunities, and get out. And so a lot of my other strategies that I used for options were more long-term strategies, and there was this, conflict of interest, and I saw that I was sabotaging myself, so to speak, by trying to have a short-term mentality and force myself to take long-term trades. So that introduced I introduced myself to the leveraged markets at that point, and I got into trading futures and also looked into trading Forex. Now, I want to say that I prefer currency futures because I do have a futures background, but if you've never traded currency futures, they really track the same moves that you would have from the Forex market, spot Forex market. So we're going to use those terms interchangeably. You could be a currency trader whether you trade Forex or whether you trade currency futures, but bottom line is we're watching the same pairs and we're trying to make money in the market. So with that said, in this webinar, we're going to focus on chart reading essentials. I'm going to show you some patterns and indicators that I use for my trading and that I have found very easy to identify, and patterns that also occur quite often in the markets that I trade. So the type of trader that would be suitable for this webinar, well, in my opinion, you could be a beginner, an intermediate trader. It probably would be a little redundant or something that an advanced trader has heard time and time again. So maybe not the best for an advanced trader, but in my experience, even if it's a concept that you understand well, sometimes when you're listening to someone else, you just pick out one new interpretation or one new idea, and that one interpretation or idea can really, change a trader from time to time. So I hope you enjoy the webinar. It sounds like we have a good group here from all over the world, which is always fun. I mentioned that I am located in California, so it's 6:34 a.m. my time, and that would be why I always refer to the morning rather than the evening. I know we have a lot of people in Europe and Asia joining us as well, so I understand it's not morning for everyone, but for me it is. So let's go ahead and get started. And before we do, probably seen this before, but we want it to be clear that trading futures, options on futures, and retail off-exchange foreign currency transactions does involve risk of loss, and it is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial situation. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. And this should not be new to you, but it's important to understand that trading, period, involves risk. And so you need to accept risk in order to see returns in the market. With that said, take a look at what we're going to cover in this webinar. In this webinar, I'm going to show you how to determine if the market is likely to go up, down, or sideways using the skill of chart reading. Now, you might notice that I mentioned skill here. I do believe that even though there are chart reading techniques that can be used to identify the direction of the market, I think that it is a skill that can be honed and that can be practiced and that you can get better with chart reading over time. So even though there will be indicators that we will discuss in chart patterns to look for, experience is going to help you become much better at chart reading. And that's ultimately our goal, to kickstart that experience and to help you understand these concepts early on if you're new to trading or if you're relatively new, but then allow you to use your experience to really get the most of these concepts and, combine the two so you could be as effective and efficient as a trader as possible. We're also going to cover the importance of support and resistance. I'm going to show you what, in my opinion, are the 3 easiest chart patterns to trade. And I'm going to also show you my 4 favorite indicators and how to use them. Before we talk about all of these chart reading ideas, I want to make sure that the difference between approaches to technical analysis or analysis in general, are clear. When you're trading, you can use fundamental or technical analysis. And there really isn't a right or a wrong. However, I do feel that technical analysis can be used solely without fundamental analysis, and I believe that technical analysis can help improve someone who does use fundamentals to trade. So I think it's important to really understand technical analysis and use it for your trading regardless of what type of trader you ultimately become. Just so you understand the difference between the two, fundamental analysis takes in balance sheets if you're looking at companies and stocks that you're trading. It looks at overall market health. Fundamental analysis can incorporate management or the strength of a government if you're trading currency pairs. And technical analysis is just that, technical. We look at market data, we interpret price and volume, and we look for trends. So again, no right or wrong here, but I strongly believe that technical analysis can be used to trade even if you do not use fundamental analysis. And if you prefer fundamental analysis, if you're a position trader and you really like analyzing, reports that are coming out, what the numbers mean, and the strength of governments or currency or interest rates, even if you do some fundamental analysis, understanding technical analysis can help you pinpoint entries in a market and also exit so you can be as effective as possible. So, what is technical analysis or why technical analysis? Well, as technical traders, we accept that market action discounts everything. We're saying that the price of a market is what matters. It really doesn't matter what the numbers were on the report because where the market is moving, up, down, or sideways, is what we are using to trade. So market action discounts everything. We also accept that price of a given security will move in trends. With technical analysis, we want historical trading patterns to repeat, or we are looking for historical trading patterns to repeat. So this is really the basis of technical analysis. We look for similar moves that have occurred in the past, and if we have found that those patterns or indicators identifying opportunities are repeating, we can look for those opportunities in the future to identify trading opportunities, which is the bottom line. Let's go back one. And I've said it a few times, but when we are using technical analysis, we are trying to decide whether the market is likely to go up, down, or sideways. 3 market directions. That's it. So why is it so hard to trade, right? I mean, bottom line, you're looking for the market to move up, down, or sideways. So as a trader, you need to have tools or chart reading skills to determine what direction the market is likely to move in. And that's exactly what we're going to be focusing on in this webinar. Now, I know this is very basic, but I'd like to make sure that everybody is clear in what I mean as when I refer to a trend or the market moving up. When the market is trending higher, we are looking for a situation where the market is making higher highs, and with each higher high, you'll see higher lows. So as a trader, what we're looking to do is identify an opportunity where the market is trending higher, and we want to buy at a point that we feel comfortable with, and we are looking to sell at a higher point in order to profit from the difference. simple enough, but I want to make sure that we're on the same page, and this is just a textbook definition for an uptrend. Downtrend, the exact opposite. We're looking to identify opportunities where there's momentum to the downside, where the market is moving lower, and technically we've made the decision that it will continue to move lower, and we can profit from a downtrend as well. Sell at a price once we've identified a downtrend, and look to buy back at a lower price in order to profit from that difference. So a textbook definition, lower lows and lower highs. The market isn't making higher highs here, and instead we continue to move lower, and as a trader we're looking to identify those opportunities and profit from that difference. A quick comment on general the way I run webinars. So I see there haven't been a whole lot of questions, and maybe it's because you've participated in a webinar of mine. I will try to answer as many questions while we are doing the presentation, but I have left time at the end to answer as many questions as I can take. So feel free to fire away, especially at the end. I know that at this point it's kind of on a basic level to make sure that we're on the same page. So that also is why you probably aren't answering questions. So feel free to interject in between, and I'll try to get to as many as possible. But at the end, we definitely will have time to answer as many questions as we can. So we discussed an uptrend. We discussed what we're looking for a downtrend. And then the third market direction is a sideways market. Well, what's happening when the market's moving sideways? We're seeing overlapping prices and no new highs or new lows. And I think that sideways markets are really the trickiest for most traders, especially when you get started, because you might learn to use a certain indicator, or you might learn to look for a certain pattern or a combination of both. But then many times if you're looking for the market to trend, if you're using a trend following strategy, which will make money when we have a trending market, you're going to get eaten up in a sideways market. You're going to see, too many signals when the market isn't moving, or you'll be losing money because you're not getting that follow through. So it's important to also know when the market is moving sideways, so you know when to stay out of the market or when to use a sideways strategy. Now, most traders struggle with strategies because they don't understand the type of market that is being traded. Is it a trending or sideways market? And this is why chart reading is one of the most important skills for a trader to develop. This leads us to the role of support and resistance. Just a basic definition here, support is a price level or range that buyers will likely enter and support the market from moving lower. So if there is a price level where the market continues to move down to, buyers might come into the market making a bet that the market will not move lower because it hasn't moved below a certain point. And so when buyers come into the market starts to move higher off of that support level. And when we identify these areas of support and resistance, we want to use caution or trade around these areas in a different way. I mentioned a price level or range. This depends on the type of trader that you are. As a day trader, I will look at the prior session's high and the prior session's low and pay attention to these specific values, these specific price levels. And I will actually treat these areas as support and resistance. As a position trader, I typically don't focus on one particular price point. Instead, it might be a range. If you're trading a currency pair, maybe it's a 5 to 10 pip range. Whereas a day trader, I might be looking at a specific level, one price. And the reason why is that when you give the market more time to move, there's a tendency for support or resistance to be more in a range than at a particular price point. Resistance is the opposite then. Resistance is a price level or range that sellers will likely enter and resist to move higher. If the market's moving higher and as a trader, you just know that the market has been there before and has failed to move higher. Now, there's a few things going on, a few dynamics here. One, you might, as a trader, if you're in a position, if you're in a long position and the market's moving higher, you know that the market failed to move higher previously on a point where you've identified a resistance, you might look to take profits on that trade. Because you might say, hey, I don't want to gamble and just assume that we're going to break through resistance. So you might take profits, and if you're in a long position, how do you take profits? You sell your position. So selling could come into the market with profit taking, which creates this resistance area. You could also have people who are sellers, looking to short the market at that particular level, making a bet that the market won't continue to move. So not only do you attract sellers potentially at resistance, but you also have traders who are in positions who might be taking profits at resistance. So yeah, it's important to understand the dynamics of support and resistance and how they can play in your trading. So we're going to just, before we do so, support and resistance can be found at round numbers, psychological levels, previous highs and lows, or at advanced technical levels. Now let's look at a basic example here. Here's an example of support. The market's moving down. Now we've created this new low here. And then, of course, the market's just not going to move in a straight line down. So we come off of these lows, and then we see that the market's moving. Now what happens here? Again, this is where some traders might get out of a short position. If they're short the market, they might close the position, which means they need to take a long position, which now closes your position. But as a buyer, to close the position creates buying around this area, and this area of support could keep the market from moving lower again. At this point in time, you might have buyers come into the market, buyers who have identified the possibility of a continued move up. So you have buying around this area. What I want to do then as a trader is, if I'm in a short position and I've identified an area of support, I would prefer to take profits here. Get out of the trade, take profits, because if the market doesn't continue to move lower, you're going to lose out on the profits that you've already achieved, or you're going to potentially take a loss on a position that initially was profitable. So I have no problem getting out when I've identified support and I'm in a short position. What I'll look for then is a breakthrough support. Now, this is where the role of support and resistance can flip, because once we break through a strong area of support, the market could continue to move lower, but what was support here, support, broken, now can become resistance. Because now traders have identified this area of support, and the same things can happen. Another basic example of resistance, here the market's moving higher. We've found a new high in the market. We come off of that high, and we see a second attempt to break through that high. As a trader, I'd want to take profits at this point, not gamble on whether the market's going to break through resistance, because I could always re-enter a trade or identify a new trading opportunity, but I don't want to give back profits that I've already locked in. And so here, I'll be cautious. I'll close the position, or at least adjust stops to make sure that a winning position does not turn into a losing position. So there is the possibility that eventually we're going to break that support level as there are multiple attempts. However, as a trader, I would not gamble on that support level broken. I've seen, a support level tested 3, 4, 5, 6 times, and if you entered on that third time, you would have had to go for, quite a ride before you eventually got to that level. So, yeah, the more it's tested, there's the potential that it's eventually going to break, but I'm going to be very cautious and treat it as strong support and resistance until it's actually broken and the market has proven otherwise. As mentioned with the examples, support and resistance can flip roles, and support becomes resistance, and resistance becomes support, and vice versa. Okay, we might be able to bring up a chart at the end and take a look at the hour chart. And I do also have a few other charts as examples that I'll bring up as well. Sometimes support and resistance is a zone. I think this is important. And for me, anyway, it's the difference between taking a position and being active as a day trader. As a day trader, I will look at particular price levels as support or resistance. And if I'm looking to be in a position, then I will look for support and resistance zone. Sometimes it is at one particular price level, but it could be a zone as well. Now, trend lines can be drawn to connect lower highs and higher lows to spot trends. It's one of the easiest ways to determine market direction. And trend lines act as support and resistance. Strong breaks could signal the reversal of the trend. So sometimes trend lines are treated completely differently than the concept of support and resistance. But I want to say here that trend lines are just support and resistance levels that are drawn not just horizontally, but at an angle. It's the same concept. It's the same idea, but instead it's connecting lower highs and higher lows to spot trends. Here's a trend line for a downtrend. The market's moving lower, and now we have a lower high. The high's up here, the market's moving down. On the retracement, we have a lower high. We continue to move lower. Now we have another lower high. Once we have these 2 points here, we can draw a trend line. And forgive the crude drawing here, but I want to make the examples clear before we look at charts. So this is very effective because on the way down, trend lines can be used to not only identify the direction of the market, but also to identify an area of possible resistance here. Because in this downtrend, as long as the market continues to move down, we could have strong resistance at this trend line. And you'll find that even on some of the most the most sophisticated charts or the most sophisticated traders that have access to all of these crazy technical tools in the creation or the ability to create their own indicators, that you'll see trend lines on some of the most sophisticated traders' charts. And it's because they can be very effective to not only identify the overall direction of the market, but also to identify possible support or resistance and pinpoint entries or exits. A trend line should be drawn above price in a downtrend. Sometimes this is switched when you are a new trader, where you have a tendency you want to draw this trend line in a downtrend connecting the lows. But that's not the case. It should be drawn above price in a downtrend. Uptrend, the exact opposite. Oops. Let's try that again. Where when the market's moving higher, we have a retracement. So now we see a higher low than we did before, but the market is moving up. Once we have this point, we're looking for a second point, a second higher low, and then we can connect these two levels to draw a trend line. And in an uptrend, a trend line should be drawn below price, and this could help you identify the direction of the market, but also it could act as support, and this could be very powerful until it's actually broken. So trend lines help identify the possible direction of the market, and really it's a support or resistance level that is not drawn horizontally. Here's an example of gold. It should be pretty easy to see. Look at this trend line. We're connecting these higher lows, and this market bounces off of this trend line here. I mean, you could have started drawing this trend line back here, even if you waited for the second point. At this point in time, we have a very strong trend for quite a while. We get another attempt here, and what happens? Once we've drawn this trend line, it becomes support. The market really starts to move, and then on the way back down, we see support again, but this time it breaks. Now, just like those horizontal support and resistance levels, once broken, it could act as resistance now. And this is exactly what happens. We break through this trend line, but now on the way up, we're tagging that trend line, and so it's acting as resistance on the way up. So that could just be a point where there is some indecision, but there's a very clear trend. And when you draw a trend line, it makes it a little easier to A, establish the direction of the market, but B, identify possible entries or exits based on support and resistance. Now, we're going to move forward and talk about advanced support and resistance. And for me, an advanced support and resistance level is a pivot point. I call it an advanced support and resistance level because it's treated the same way, but you either need to do a calculation to identify a pivot point, or you have to use charting software to do the calculation for you. So it's not as easy as just connecting the dots as it is when you're drawing a trend line or identifying possible support and resistance in a more basic fashion. Now, pivot points have been referred to as floor trader pivots because they're based on the high, low, and close of the period being traded. Now, the floors at the major exchanges have changed. If you're not aware of what the floors have been like in the past and what they're like now, everything's going electronic. I mean, even the floors that are still in existence, there's electronic contracts that are being traded side by side. Now, even commodities in the U.S., the Chicago Board of Trade, have electronic contracts that are being traded. But when we had this heyday of floor trading, and floor traders were very active, now you had to make trading decisions before computers. You had to, make decisions while you were on that floor, almost, in seconds. Well, definitely in seconds. And they were armed with very few tools. But what they found very effective was the use of support and resistance, and they took with them three numbers: the high of the previous session, the low of the previous session, and the close of the previous session. So every floor trader would go and approach the trading day knowing what those three numbers were. And pivot points were created based on those three numbers. A 5-point calculation is typically the most popular, where you will have 5 pivot points. But there are a few different variations that you might find out there. The main pivot point is just the average price of the prior session. What do I mean by that? The main pivot point takes the high, the low, and the closing price of the period that is being traded. So if you're looking at yesterday's trading, you take the high, low, and close, and you add those prices together. How do you get the average then? Well, you divide by 3. And that's exactly what the main pivot point. So the main pivot point is nice because it's letting you know what was the average price of the prior session based on the high, low, and close. And so for some traders, it helps you make decisions on whether trading for the day is bullish or bearish. Now, I'm going to go through the calculation real quick here, but I don't want to spend too much time on the calculation. You could go to Investopedia. I'm sure that FX Street has some great articles and commentary on pivot points from other traders. But just to give you an idea, the main pivot is the high-low close of the previous session. And when you are doing a 5-point calculation, you will have the main pivot, 2 resistance pivots, and 2 support pivots. So R1 takes the pivot point, multiplies that by 2, and subtracts the low of the prior session. R2 takes the pivot point calculation and adds the R1 level and subtracts S1. But this isn't as important to me because many times you will have access to charting software that will calculate pivot points for you, or there are pivot point calculators on the internet. You just plug in those prices and you're set. Yeah, previous days high and low. And some traders, since currencies trade overnight, some traders will use the close of the U.S. session, 415, to have that closing price. Some traders will use the whole session, but most of the time, depending on the markets you're trading, it will be based on the actual U.S. session. But again, your charting package typically will provide these values for you. And even if there are slightly different interpretations or calculations, you'll typically find that universally they're pretty similar in nature. So with pivot points, what can we do with them? Well, in my opinion, the 3 most important levels are the main pivot point, the resistance 1, R1, and the S1 level. Some traders will take a pivot point and just use that pivot point to have a bias in the market for the day. If trading is above the pivot point, then they might consider trading to be bullish for the day. If trading is below the pivot point, they might consider it to be bearish for the day. And you'll find that many strong trends will occur if the market is going to trend higher. Typically, you'll see a break above the R1 level. Or if the market is going to trend lower, there could be a break below the S1 level. Now, the R2 and the S2 levels are going to be the furthest away from the main pivot point. And so sometimes there can be reversals when we encounter the R2 or S2 pivot. But this doesn't always happen. So what I would do is, pay attention to the R2, S2 level if you are using pivot point and use a little more caution. But in very strong markets where there's clear direction, there's nothing that's going to cap the market move, definitely. So just use caution when we get to those levels. Just like overbought and oversold indicators, when we start to get to those extremes, there needs to be some strong trading in order for that trend to continue. Yeah. Okay. So today there's been some strong trading. Here's just an example on the Euro futures contract. Just if you haven't seen pivot points, and actually I wish I included all 5, but the reason why you don't have all 5 is because price didn't trade up to the R2 pivot, which would be above here, or down to the S2 pivot, which would be down here. But what you see here is a chart of the Euro futures contract, which is just to be used as an example. This blue line is your main pivot point. The R1 resistance pivot is red, and the S1 pivot is green. So what do we see here on this chart? Well, earlier in the session, we traded, and we actually got through this S1 pivot a little bit, but then look at what happened. The market really has a tough time continuing to move through the S1 pivot, and look at this. We find support here at this S1 pivot. Now, as the market's moving higher, we see that a bar trades right up to this pivot point, but then continues to move through. Where does the market encounter resistance? Where does it stop? Right at R1. So even though we went through this main pivot point, let me go back to that. There we go. Even though we got through this main pivot point, the next pause in market direction was at the R1 level. So if you're a trader and you've identified a trend, here my bars are colored red and green based on what's going on in MACD. I'll talk a little bit more about that in this webinar. But if you've identified a trend here and let's say you go long, at this point in time, I would be taking profits, managing my stop, or closing half a position just to make sure that I lock in profits. I'm not going to demand that the market break through this R1 pivot. I want to make sure that I'm profitable because I've identified a trend. I've entered a trade, let's say, and now I don't want to just assume that we're going to break through this level. But once we break through that level, now we get a nice strong move. Now what happens? We come right back down to the R1 level, and as we mentioned before, the role of what was resistance now is clearly acting as support. So this leads us to a discussion on Fibonacci levels. I call this advanced support and resistance because these levels can be treated as support and resistance, but you have to use a drawing tool or you have to calculate them in a more complex way. So why Fibonacci levels? Well, markets have a tendency to retrace before continuing in the direction of a trend. So Fibonacci levels are calculations that identify possible retracements, and supports can be found at these levels. The most popular retracement levels are the 38.2% retracement, 50%, and 61.8%. Now, for the sake of simplicity, some people will just call it the 38%, 50, and 62, rounding that up. Well, why are Fibonacci levels popular? Why do they exist? What are they? And what can we do with them? If you're new to the idea of Fibonacci retracement, or Fibonacci levels in general, it's such a fascinating concept. It's based on the golden ratio, and these ratios occur naturally in the universe. The distance between our planets as a ratio are all Fibonacci ratios. The distance with concentric circles in this shell here, Each shell, it's a repeating pattern, right? And the ratio, as they get bigger, is going to be a Fibonacci level, or a Fibonacci ratio, excuse me. Taking the difference between your digits in your arm, if you take those distances and you identify a ratio, all of these, naturally occurring ratios that occur in nature are these Fibonacci ratios. It's just a fascinating concept. It happens everywhere in the universe. And what people started to do is take this idea and apply it to the market. And the rationale behind it is, well, markets are, driven by humans, right? So they represent emotions, they represent fear and greed, and those movements in the market, like they occur naturally in nature, can also, take place. Now, some people think it's a bunch of hocus pocus. Like, oh, what do you mean that I could take this scientific ratio and apply it to the market? Well, whether or not it's hocus pocus or not, the truth is that when enough people believe in a concept or believe in an idea, even if it's hocus pocus, it could be self-fulfilling in nature. So, it is something to keep an eye on. And I know that many currency traders use Fibonacci ratios and retracements pretty effectively. So, here we have just 3 basic examples of the most popular retracement levels: 38%, 50, and 62. What I mean is, from the low to the high in a move, a 38% retracement could be a support level. So if you're looking at a trend and you're expecting a retracement, and we get down to the 38% mark, and then the trend begins to continue, that can help you identify a long opportunity. Now, 50% retracement would be half of the move. 62% would be almost 2/3 of the move. Now, a few comments here. Most traders feel most comfortable with a 38% retracement or the 50% retracement. The 50% retracement is just, a textbook technical analysis retracement that has been identified and used forever. Because we know that a market isn't just going to go straight up or straight down, and if there's a retracement that's 50% of the previous move, many traders feel comfortable with it. So something to keep an eye on. The 62% level gets a little tricky, because when we start to get beyond a 50% retracement, that's when we could really see weakness in a market. So it's a little more comfortable to find 38 and 50% retracement. So, yeah, easy to see in hindsight. To be honest, I do not use Fibonacci levels with my trading. I use pivot points. I think that I've had conversations with many currency traders that use Fibonacci levels very effectively. So this is why I bring it up in this webinar. But I prefer pivot points. I use pivot points on my charts, and the Fibonacci retracements can get tricky. Sometimes it's very easy and very clear. I mean, here's a move. And it sounds like we're getting commentary both ways. Boyke's laughing out loud when it's easy to see in hindsight, and we see the comments, the last 3 swings on the euro dollar stopped at the 50% of that last swing. 2 stopped it for the pound dollar, stopped at 62. Row Trader uses them a lot. So, there's a difference in opinion on Fibonacci retracements. And whether you use Fibonacci retracements or any of the concepts that we'll discuss in this webinar, you have to make sure that it fits you, that it helps you. If it doesn't help you, don't use it. But hopefully this webinar will give you some ideas on concepts that you can incorporate to help you identify direction of the market. Now, actually, I have a chart. I think it's the euro against the dollar that I'm going to bring up at the end, where it's just a beautiful example of a retracement, but I wanted to show this one. I had this from a previous webinar. And with a Fibonacci drawing tool, we just connect the high of a move down to the low of a move. So the high down to the low. And then as the market starts to move up, where does this move end? Where does this retracement end? Nice big downtrend here. This is on a corn daily chart. And where do we stop? Well, this is that 38% mark. If you look at the closing price for this day could have been anywhere, right? I mean, it could have been here. I mean, you look at the ticks, there were probably, 50 different closing prices it could have been, but it was right at that 38% mark. So, again, even if you're not really buying into the Fibonacci retracement idea, if you find that it helps you, it is something that is used frequently with traders around the world, so it can be a self-fulfilling prophecy, and this is where that retracement ends. And then what happens? Well, we see some support down here. We break through support. What happens after we break through support? Support becomes resistance, and then we get a little bit of a sideways move after that downtrend. Anyway, we'll look at more examples at the end. I just want to go through a few more concepts first. So this leads us to a discussion on indicators. And before we talk about indicators, I want to mention that really there are going to be three ways to read charts. Actually, we'll look at a few patterns first. The three ways to read charts are to look for patterns, repeating patterns in the market, and we'll look at a couple today. To use indicators, which are calculations, manipulation of price and data to identify opportunities in the market or possible direction in the market, or a combination of both. I mean, those are the three ways to read charts. So let's start with patterns. What is a chart pattern? A repeating price pattern used to identify the possibility of trend continuation or trend reversal. Patterns are meant to identify those two things, the trend continuing or the trend potentially reversing. And then once you've identified trend continuation or trend reversal, you can decide whether the market's moving up, down, or sideways. The easiest chart patterns to trade, in my opinion, a double top and double bottom, a head and shoulders pattern, and triangles. First, look at a double top. This is a bearish pattern, and what we're seeing here, it really incorporates support and resistance in everything that we've talked about. It's just a pattern that occurs frequently. The market moves up. We see a high in that market. Of course, we're not going to move up indefinitely, so we have a retracement. Maybe this is a 50% retracement here, a Fibonacci level. Doesn't really matter with a double top. But as the market moves higher again, with a double top, what's taking place is this area could act as possible resistance, right? So as a trader, a healthy trend would move through this resistance area and continue to move up. But if we cannot move through that level, and then the market moves down, this is a double top. Now, there's really 2 points to keep an eye on. One, the peaks here, right? Because double top is going to experience resistance on that second attempt or that second peak, but also the trough, this low in between these 2 peaks. So an aggressive way to trade double tops is to look for opportunities to short the market here. Once say you're using indicators, if you've identified a downtrend, an aggressive way to trade this is to look for a short opportunity here, expecting the market to get back down to this low. A more conservative way and a textbook way to trade this is to wait for a break through this trough here, right? So what we're really looking for is a move higher, the low in between, a second attempt. Here you have your double top and your 2 peaks. But as a trader, for a more conservative way to trade this is to wait for that break, because once we get a break through this level, we could see a downtrend. Otherwise, we might see the market start to go sideways at that point if we don't break through that level. Here's an example of the 30-year bond market, and just a beautiful double top. Market moves up. We see an area of resistance. We find lows in between that this second attempt at this peak, and what we look for. Again, technically, if indicators tell you could take advantage of a move earlier, that's fine. But a technical way to trade this is to wait for a breakthrough. Well, that's the thing. If you start to see 3 or 4 tops, then it could be more of an indication of a sideways market. It's the double top that's a pattern that people have identified that they feel comfortable with. It doesn't mean that 3 or 4 tops can't be something to keep an eye on, but the most important thing is to see, okay, are we trading sideways? Because as we go to 3 or 4 tops, it could be that we're really in a sideways market, or are we trending? And then we need that break, which could take a while if you see 3 or 4. Double bottom is the exact opposite, and this is bullish. Here we have a low. We come off of those lows. We have a second attempt to move down through that low. And again, there are really 2 points that we're keeping an eye on. With the second attempt, we're keeping an eye on the first low. And if we do not break through that low, we're keeping an eye on the high in between those 2 lows. Because a move through that high could indicate a trending market at this point. Yeah, Paulie mentions there seems to be a lot of head fakes on patterns too because everyone is looking at the same thing. Now this is where with chart reading, again, you can look for patterns, you can use indicators, or a combination of both. I think that a combination of both can be very effective. It could help you at times avoid some of those head fakes. And another thing to mention too is that sometimes patterns are difficult for traders to identify in live market conditions. Why? Because it does take practice. It does take experience. Screen time is so important in this business, and with more experience, you will get more comfortable. But this is one reason why some traders prefer indicators, especially when they're starting, because indicators are giving you specific values. There isn't a whole lot of interpretation where there is a lot of subjectivity and interpretation with patterns. Here's a double bottom example. Market moves down, creates a new low. There was a double bottom here that could have been identified as well, but we didn't get through the high in between those 2 lows. So that's what we would be looking for a strong break. We have a low, we come off of that low, a second attempt, we do not break through that low, and now you see the market does kind of move sideways for a bit, so it could drop back down, and then we have strong support here, but then eventually it breaks through the high in between these 2 lows. That break what we'd be looking for. Okay, head and shoulders, bearish. Move up, retracement. This time, a head and shoulder pattern at one point is going to look like a possible double top, right? Because on the second attempt higher, the head and shoulders pattern, instead of moving down, we actually break through that previous high. So now this is a strong trend at this point. We come off of that high, and then it's this third attempt that we're keeping an eye on for a head and shoulders pattern. You have your left shoulder here, the head here, and the right shoulder. Sometimes the right and left shoulder could be at the same level. The right shoulder could be higher. It really doesn't matter. The key here is this peak in between, because usually this peak will be on strong volume and be a very strong move. And if on this third attempt the market just kind of fizzles and we're not really seeing strength approaching this high, that could be a head and shoulders pattern. But just like with a double top, a strong reading and a strong trading opportunity is a breakthrough the low in between. Here we can connect these 2 lows since they're not always going to be perfect in a horizontal line, and this is known as the neckline. So a strong pattern is to look for a head and shoulders pattern and to look for that break through the neckline. Inverted head and shoulders pattern is bullish. It's just the opposite. We have a low, we come off of that low, we make new lows. Again, right now, this looks like a strong trend to me, and I would be looking for a continuation once we get a little retracement here. But on this third attempt, if we're not able to break through that level, we could have an inverted head and shoulders pattern, and I kind of drew this so it almost looks like a double bottom, but I think you get the point. Triangles are also very effective. And I like to look at triangles. I think that they make sense in that they're easy to trade, especially as a short-term trader. Here, bearish triangles, you have 2 different situations. A symmetrical triangle. Oops. Let's go back one. So bearish triangles, you have a symmetrical triangle where the market has come from higher and is now moving lower. And what you see here are diminishing highs and lows. What's happening is as each retracement takes place, we're seeing lower highs. And each move lower is actually a higher low. So what are we doing now? We're just drawing trend lines. So with chart patterns, it's taking the knowledge of trend lines in support and resistance and really using them to look for repeating patterns. So as the market moves, you see that there's less enthusiasm, and what we're looking for is a break through this lower trend line, and this could indicate a trend down. So a situation that is similar but a little different is a descending triangle. This is where the lows are the same. So there's clear support there, but you still have those diminishing highs on the retracement. So just a little bit different, but pretty easy to identify, especially in different time frames. Here we have a bullish pattern. This is a symmetrical triangle where we have diminishing highs and diminishing lows. We're seeing that on each attempt higher, we don't get as high as the previous attempt, and on each attempt lower, we're not getting through those lows. And for a bullish symmetrical triangle, we're looking for an uptrend, which would be a continuation of this trend. We also have an ascending triangle where we have a strong area of resistance. The market has identified an area of resistance, but we're seeing the market not move as low on the retracements. We can draw a trend line here and a resistance line here. That breakthrough is what we're looking for, and this would be an ascending bullish triangle. Here's an example on Apple Computer. We see that these lows are getting higher. We see the highs are getting lower, and we're coming into this triangle. So what we're looking for is a break in either direction. On this occasion, we got a breakthrough, and the market moved higher. So this leads us to a discussion on indicators. And I like indicators, but I think that many traders get stuck trying to use an indicator thinking that it's the holy grail when they first discover it. And I think that a combination of indicators is very effective. What is an indicator? Well, an indicator is a calculation that is used for trading that's essentially a manipulation of price, time, and sometimes volume. So indicators are used to revisualize market moves. Because if you didn't need indicators or you didn't use indicators, you just look at price and time. You see where price is at and at what time it's at that price, right? Indicators are calculations that are meant to help you determine the direction if it's not as easy for you to determine simply by looking at a chart. An oscillator is a trend indicator that oscillates between overbought and oversold conditions. Indicators are used to spot trending markets. That's where we're looking for trend continuation. To spot overbought and oversold markets, that's where we are looking for trend reversal. And to analyze market moves and make decisions. So the first is the most basic, and that's moving averages. The most common indicator, and most traders are going to look at two types of moving averages. A simple moving average, which is the average of closing prices over a given period. So if you're looking at a 7-day moving average of the last 7 days on the euro against the dollar, you take the closing price of those 7 days, add them together, divide by 7. Easy calculation, and that gives you the simple moving average. Exponential moving average is exponentially weighted, where it takes the closing prices, but there's going to be more weight given to the most recent close. The idea behind that is the most recent trading prices are going to be the most relevant, and instead of each day having the same weight, it's going to be exponentially weighted, so the most recent are given more weight in the actual average. Moving averages help traders identify trends in two ways. One, by viewing price in relation to the moving average. Some traders will just use the moving average to help see how price is relating to the actual average of that market. Where if the price is above that moving average, then they might be bullish and might look for to use strategies that identify uptrends, or if we're below that moving average, we might be bearish. And others will look for short-term, long-term moving average crossovers, combining two moving averages to identify opportunities. Now, most traders that I know do not use moving averages alone to make decisions, but instead they often will use moving averages as building blocks for strategies. So if you get more into strategy creation, this webinar is based on chart reading, how to determine the direction of the market, but strategies will pinpoint actual entries and exits. Many traders will use moving averages to build upon strategies that they intend on using or that they are testing. Here's an example of an 8-period moving average and a 20-period moving average. And this one happens to be on Google for the few of you who trade stock. Now, if you take a look at this chart, this is actually a couple months old because the market's come off of those highs. But the price alone, if you got rid of these moving averages, it'd probably be pretty easy to see that the market's in an uptrend, right? But this is where, as traders, sometimes it might seem as though the market's in a move, but difficult to make decisions. And so moving averages can help make those decisions because the short-term moving average should be above the long-term moving average in a strong trend. And here we see that that's exactly what happens. Throughout this move, there's a few times we get close, but throughout this very nice move of almost 200 points, the short-term moving average was above the long-term moving average. So if you're looking at moving average crossovers, when the short is above the long, we could look for the market to trend up. If the short's below the long-term moving average, we could look for the market to trend down. Here we see the most recent example of Google, and you see that really just looking for these crossovers can be effective because even though it gets a little dicey here, we have the low cross below the short-term moving average cross below the long-term moving average here. And what do we also have? Well, a few things going for us. Drawing trend lines, we could identify a downtrend. Using crossovers, we could identify a trend or a trend. And look at this. Even if we use these lows as support, a breakthrough support, it's just a matter of getting comfortable reading the charts to identify your trading opportunities. Now, I mentioned that some traders might use a moving average to reference price to see where it is in relation to that moving average to be bullish or bearish on the market. And this was just used as an example, a 30-day moving average. And we see that in a trend, most of the closes are above the moving average. Every now and then you get one close below, but you didn't get two consecutive closes below in this entire move up, right? And then once we did close below twice, now that trend has changed. Well, you don't need the simple moving average to tell you this if you're comfortable drawing trend lines. The trend line basically tells you the same thing, but the trend line might even be more effective for you and easier to draw. So there isn't a right or a wrong here. It's what helps you make decisions on the trend of the market, what you feel most comfortable with. The trend line, for some people, could be much easier to apply and very effective. For others, maybe it's looking for two closes below the moving average or two closes above the moving average to help in direction. Well, Paulie, I think that that's a good concept. Paulie says Dr. Elder talks about using moving averages for getting a fair price for what you want to buy or sell, and that's the concept behind using a moving average to reference price. So, again, there isn't a right or wrong there, but yeah, I think that if you are using a moving average that flows well with a market that is moving, it can help give you a fair price, and then it's a matter of you interpreting that to make decisions. Now, for some of you, moving averages might be a little basic, and I want to talk about MACD, another popular indicator. Right? I think that this indicator is very powerful, even though it's pretty simple to use. It's a momentum oscillator, and this indicator really centers around a MACD line. And this MACD line is giving us a reading that will show the difference between two moving averages. So those moving averages that we looked at before as an example, now we are using them in MACD to get readings. And so the difference is typically going to be using a 12-period exponential moving average and a 26-period exponential moving average. The difference between those two moving averages are plotted as the MACD line. Now with MACD, you'll typically find that as a MACD study, there will be a trigger or signal line. Trigger and signal line being used interchangeably. What this is actually a moving average of MACD itself. It's a 9-period exponential moving average by default. So it's kind of an indicator on an indicator. So even if you find that moving averages are basic, or even if you find that you do not use moving averages to make trading decisions, here's a situation where moving averages are part of an indicator that you're using. So it makes sense to have some knowledge here on what's going on, just so you feel more comfortable with an indicator that you might use to make trading decisions. With a MACD study, you'll often find a center or zero line, center line and zero line used interchangeably, and this is telling us when both exponential moving averages are equal. With a MACD study, you'll often see that a histogram is present, moving above and below that zero line, and this is giving us the difference between MACD and the signal line. And yeah, Gordy, I use the standard settings for my trading with my strategies, and the strategies that we use at Rockwell. It doesn't mean that you can't use other settings. I know that there are some other settings that are popular, and here we see someone's using 12, 55, and 8. It's really what helps you identify opportunities in the market. And yeah, the founder of MACD actually initially created two settings, one to identify long opportunities and one to identify short opportunities. And using two settings depending on whether you had an uptrend or you were identifying a downtrend. For my trading, this isn't important. I can use the standard settings, 12, 26, and 9. So it doesn't mean that that's the only way to trade, but you want to make sure that if you are using different settings, that it helps you spot opportunity. That's the bottom line. Now, if you haven't looked at MACD before, it's pretty easy to read, actually. This MACD line here is blue, right? So this is the MACD line. This is the difference between these two moving averages. And then this is our signal line or trigger line that is purple, right? So this is an exponential moving average of MACD. And then you also have the zero line here, which again is telling us when the short-term and long-term moving averages are the same, MACD will be at the zero line. And the histogram here that's green or that's red, this is showing us the difference between MACD and the signal line. So when it's very, very low, when this histogram is very short bars, we are very close to MACD and the exponential moving average, close to coming together. When they get further apart, we see that they start to expand. And then when the MACD line crosses below the signal line, we start to get a negative histogram here. Yeah, there are lagging indicators, and this is whenever something takes price and takes something that has occurred in the past and plots an indicator or does a calculation based on price, it's really going to be lagging. So I think we can combat that by combining different indicators or using other trading ideas to offset that. It doesn't make it right or wrong, but some would say that's the case against indicators. I disagree. I think it's just understanding what you're looking to achieve and the strategy that you're using in a market. So what's a bullish signal? What do we look for an uptrend? MACD crossing above the signal line is considered bullish. So that blue line, the MACD line itself being above the signal line, and MACD above the zero line is also considered bullish. Remember that MACD at the zero line means that those two moving averages are the same. So if the short term starts to get much higher than the long term, we're going to have a positive MACD rating. Bearish signals or a downtrend is the opposite. MACD crossover below the signal line or MACD below the zero line. This is a chart of the mini S&P 500. Again, I'm a futures trader. I like currency futures. I think currencies are great, but for me, it's easy to trade with the other futures market. If Forex is your area of interest, it's really the same thing as identifying trends and opportunities. Here we see that I have green bars highlighted and red bars highlighted. What's taking place when the green bars are highlighted? Well, I mentioned that MACD could be bullish or could identify an uptrend when MACD is above the zero line. We're above the zero line here, so why aren't all of these bars green? Well, for one of the strategies that I use, I look for MACD not only to be above the zero line, but to be above the signal line. So when MACD is below the signal line and above the zero line, we get black bars. See this here? MACD is below the signal line. Once we pop up above the signal line, now we get green bars. And here we have nice trend. Up to where? Well, this is that R2 pivot. Look at where the market stops. You have your pivot point here, your R1 pivot, your R2 pivot. Market moves up here, and then we do not see much follow through after hitting that R2 pivot. Now, for a downtrend, you could look for MACD to be below the signal line, which takes place here. Right? I'm getting black bars here because based on the strategies I use for trending markets, this is, for me, a little too early. So, because, yeah, the market does move down from this point, but I want to avoid situations like this. Here, when we have black bars, I think it's clear to see that the black bars are helping us stay out of a sideways market. Yeah, MACD is below the signal line, which could be bearish, but the movement itself is really sideways. And that's why a more conservative interpretation of trends with MACD is to have MACD greater than zero and greater than the signal line, or MACD less than zero and less than the signal line, which is the calculation for this red bar. The signal line, again, is an exponential moving average of MACD itself. Someone made a comment about my cow instead of a bull. Yeah. Well, maybe cows make money too. So tips. Flat MACD can indicate a sideways market. So you might want to take a look at MACD, and instead of only focusing on how it relates to the signal line and zero line, see the slope of MACD itself. Because if it's very flat, this could mean that we're in a sideways market, not a trending market. And you might want to wait for a clear cross of MACD and the signal line to avoid fake outs. That's one of the reasons that with the bars that I had highlighted red and green, that we didn't look for a trend as soon as there was a MACD signal line cross, but we looked for there to be that cross and then for MACD to either be below the zero line for a downtrend or above the zero line for an uptrend. And you might use caution entering long trades when MACD is below the zero line and short trades when MACD is above. Same idea that I just said in another way. This leads us to a discussion on Bollinger Bands. And Bollinger Bands are a volatility indicator. So Bollinger Bands will consist of 3 bands, and these 3 bands are going to represent a simple moving average. The standard is typically a 20-period simple moving average, sometimes 18. And then the other 2 bands are going to be based on a 2 standard deviation of that moving average. So the upper and lower band are adjusting based on volatility. They're giving us standard deviations of the moving average that we're using. Now, we'll look at an example here, but traders who are looking at the possibility of an uptrend, when they're looking at Bollinger Bands, they might identify a possible uptrend when price is at the lower band. Okay, and that's a very common way to use Bollinger Bands. Now, the second thing to look for is if price is actually pushing through the upper band, especially when confirmed by another indicator or technical analysis, that could also be a bullish signal. So it might sound like I'm contradicting myself between option 1 and option 2 here, but we'll look at a chart and I'll show you exactly what I mean. And 3, if the upper Bollinger Band, is clearly pointing up and price is moving up, that could also indicate the possibility of an uptrend. Bearish signals, the opposite. Price at the upper band. So if price is hitting that upper band, that upper boundary, that could indicate the potential for the market to drop and go down. But it could also be that price pushing through the lower band, especially when confirmed by another indicator or technical analysis, could also identify a downtrend. And if the lower band is pointing down and price is moving down, that could also identify movement in the market and a trend lower. Let's look at a chart so I could show you a little bit more about what I mean. Now, I mentioned that a bearish signal could be when price is at the upper band, and a bullish signal could be when price is at the lower band. And this is probably the easiest way to trade Bollinger Bands and the first way most traders learn to trade Bollinger Bands. But it's not the easiest way to make money with Bollinger Bands, in my opinion. And if you do make money when you're using this concept and idea, it's usually because you've gotten lucky with market direction. Because this would simply be fading the market, right? Because price itself is making a high here, right? Look at the chart. Price is making a high, and if you're selling this upper band, then you're fading this trend. We have an uptrend, you're fading this trend by selling, and then the idea would be to buy or reverse the trade when the lower band gets hit, and to continue to do so. And so it works okay, but usually when the market is sideways. Now, I also mentioned that in a downtrend, price sometimes will hit the lower band, and price will move down with the lower band angling down. And look at that. Look at this nice downtrend. So price is hitting this lower band and continuing to move down. Do you want to be a buyer here? Do you really want to buy here and hope that we're able to sell the upper band? Well, that's where it gets a little tricky sometimes when you just take this basic concept, the fade band. Because when, and John Bollinger will say this himself, when price is tagging a band and pushing through it, there's a tendency for a continuation of the trend. So something to keep an eye on with Bollinger Bands. A nice downtrend here, and the lower band is clearly pointing down, and we also see that price is really riding against that lower band. In a nice uptrend here, price is tagging that upper band, and the upper band is pointing up. Here, when we are really in a sideways market, the Bollinger Bands are flattening, and we're hitting that upper band, bouncing off the lower band, and that's where fading strategy can be popular. Here's that simple moving average. Some traders might reference it with their trading, but in my opinion, the most important thing here for the type of trading that I do is to really keep an eye on the upper and lower band. And Paulie mentions when Bollingers and Fibonacci's intersect, it could generate powerful signals. And that's a combination of these ideas that we've been discussing. And I think that that's very important to not just use an indicator and try and use it in isolation, because there's a tendency to look at an indicator here and say, wow, Bollinger Bands, if I did this and this, I would make a ton of money. And then you're so excited about this one indicator, but then you really struggle when you're not getting that optimal market condition. So a combination can help you avoid some of the fake outs that can occur in the market. Here's just another example of reading Bollinger Bands a little bit better. With that trend that we just discussed, here we talked about MACD. It's the same chart, but instead now look at the Bollinger Bands. See how flat they are? We have a sideways market. MACDs could be also telling you that you have a sideways market because MACD isn't above or isn't below the zero line. So you might look at MACD for this decision. You might look at Bollinger Bands for this decision. But in a nice uptrend, MACD is confirming that trend, and price is riding up that upper band. That's great. Look at here. Flat MACD, flat Bollinger Bands just a little bit, even though MACD goes bearish. But we have a nice downtrend here, and price is really riding and tagging that lower band. Now, here's a great example of a pivot point. We have an R1 pivot point, which could act as possible support. Price does push through it a little bit, and then it acts as resistance temporarily. Now here it acted clearly as support. Now it acts as resistance and then drops back down to that pivot point. Alright, so a few tips. Buying and selling bands will not work in trending markets. A very common approach to using Bollinger Bands, a little basic in nature, but it can work in sideways markets, but in trending markets you're going to get killed. Band squeezing could indicate low volatility, well, does indicate a low volatility market, which is typically sideways, and keeping an eye on the squeezing bands could help you find opportunities where there's the possibility of an upcoming breakout. And also, short-term traders should adjust the simple moving average to a smaller time frame, typically recommended to be between 9 and 12 periods. So, there isn't a right or wrong with the settings. The settings are meant to be adjusted to give you control over the, creation, the manipulation of the price and the data that is being used for that indicator. And typically when you have a lower setting, it's more responsive. You'll have more signals occurring, and that could be good or bad. It depends on the type of trading that you do. For Bollinger Bands, the typical setting is an 18 or 20 period setting with a 2 standard deviation. And for short-term traders, you might want to adjust that down to 9 or 12. But a 2 period standard deviation typically will work well, and price is usually going to be within those 2 bands 90% of the time. So, let's look at one more. This is RSI. RSI is a momentum oscillator between 0 and 100. It will give us readings between 0 and 100. And RSI measures the size of recent gains to the size of recent losses. Overbought is typically with a reading above 70, and oversold is typically with a reading below 30. And this is to identify possible reversals in the market. If there's a possibility that a market is overbought, then there could be a high likelihood that the market is going to move down. If the market's oversold, there could be the likelihood that the market is ready to move up. More conservative readings would be to look for an 80-20 reading instead of the 70-30. Bullish signals, so identifying uptrends. If we are oversold and we have a reading below 30, and then we rise back above 30, that could be a bullish sign. Also, if we are below the 50 mark or the center line and RSI rises above 50, this could also be bullish. Bearish, when we have an overbought reading above 70 and we drop back below 70, or when there is a center line cross below 50. Let's look at a chart though. I've just added RSI to the Bollinger Bands here, and here we have the 70 reading, which is this dotted line here, and a 30 reading, which is this dotted line down below. Now, what you'll look for is when there is a reading above 70, this could indicate an overbought market. But this is where it gets a little tricky here. And this is why I think that RSI is a great indicator, but it's best used in conjunction with another indicator. Because if a market is in a nice strong trend, RSI is typically going to give you an overbought reading, right? So if you have an overbought reading here, an overbought reading could be telling you, yeah, I need to go short, but here we see that we're in a strong uptrend. So instead of just looking at the reading itself, you might wait for a dip back below 70. So if we were above 70 and we dip back below 70, this could be a sign that the market is now turning. Now look at what happens. The market pulls back a little bit and goes sideways. And then when we pop back above 70, the market is trending. So I wouldn't take the readings at face value. Instead, I would understand, get comfortable with RSI. Watch it a little bit because I think it's a very powerful indicator. But I think that if you just take those readings and think you're going to make trading decisions on it, it could really frustrate you. Instead, look at situations like this. Now, here we had an uptrend. RSI was overbought most of the time, and being a short seller here would have really been challenging. But look at what happens here. We move above RSI, or above 70 with our RSI reading, indicating an oversold market. We're making new highs. And then we drop back below the 70 mark, and we continue to move lower. Well, we never pop back above 70 like we did back here. So it's important to see where where RSI is giving us a reading in relation to whether you're using 70 or 80 for overbought conditions and 30 or 20 for oversold conditions. And instead, make sure that you're not getting faked out as the market's continuing to trend. I mentioned that a 50-line cross could also indicate a possibility of a trend. Here, I should have drawn it on my chart, but I didn't. The 50 mark's right about here. And coming from oversold, we have an oversold reading here. We pop above 30, and then we continue to move above 50. If you were looking at an uptrend here, this gives you a pretty nice entry point as the market continues to trend higher. On the way back down, it looks like the 50 mark might have been around here. Now, that really doesn't give you a whole lot of opportunity unless you went short again with the crossover here. But hey, 2 out of 3 with the 50 crosses isn't bad. But the key is to go from an overbought reading and then get a 50 mark reading, or go from an oversold reading and then get a 50 mark. When RSI is just ranging like it is here, this is typically a sign that we have a trending or a sideways market. So someone asks, what period do I use for RSI? Because I'm a day trader, I use a setting of 7. And that kind of leads us to our next slide. A few tips with RSI. Don't trade the first signal. Look for the cross back below 70 or above 30, and then take profits or consider an opportunity. Kind of what we've been discussing on that previous slide. Another tip, RSI can exhibit the same chart patterns as price. So we talked about double tops. We talked about head and shoulders patterns. We talked about triangles. You can draw those same patterns on RSI. And that makes it kind of fun when you start to see those patterns. You might choose to combine reversal patterns, those chart patterns that we talked about, with RSI instead of using RSI exclusively. The combination can be very powerful. And you might consider a 7 or 9 period setting for short-term trading. The default is usually going to be 14. But remember that any adjustments are meant to help you identify opportunity. So it kind of depends on the strategies that you're going to use and the opportunities that you're looking for when we make those adjustments. So as a summary, chart patterns and indicators can be used to identify potential trends and reversals in a market. There isn't one magic pattern or indicator, but used as tools, traders can determine when the market is likely to go up, down, or sideways. Most traders find that a combination of patterns and indicators to be effective, then use strategies to pinpoint entries and exits. And that's exactly what I would encourage you to do. Read the market, learn chart reading skills, and understand the potential for the market to move up, down, or sideways, whether it be with chart patterns, indicators, or a combination of both. And then apply the correct strategy to the market that you have identified. So you should be armed with a trending strategy where you can identify trending markets and take profits in trending markets. And also a sideways strategy that can be traded when the market is not trending. Or you just need to make sure that you are out of the market when the market is sideways. Just a few charts here. I know that we're coming to the end of this webinar. Just a few examples. Here's Chevron. This was actually taken, I think, a week ago. Look at this trend line. Look at this trend line here. Nice downtrend, but look at where we found support for the year. Support has been identified, and so if you are a stock trader, at this point, we've been in a nice downtrend, but we're getting what? Technically, this is a big old triangle, and so what I would be looking for is a break through this trend line or a breakthrough support level as the market gets tighter within those two values. Here's a Fibonacci example of the pound against the dollar, and if we take the high of the high of the last move and the low of this trend here, look at where we're at. The 38% retracement acted as some resistance here, and we started to move back down, but we didn't get back down to that low. Now we're kind of drifting up to that 50% retracement mark. So I'd keep an eye on this. We have a Fibonacci retracement, whether you're looking at 38 or 50, and see if we can get back down to the low that was established in June, or see if we break above 62 to see if we could get back to those highs. Now really, either direction works for me, but this is where a little market analysis and chart reading skills can help you decide when to stay out. And at this point, I would stay out until I see some direction either way. Here's a trend line with the pound against the dollar. Nice downtrend. We're connecting those, and look at support was identified back here, right? The lows that were in March. Well, here's another example of support acting as resistance. Once we break through these levels, we have a nice move, and now trading right back near it. And at this point in time, I think that there's some cause for indecision unless we break above this level here, another round number, which could act as resistance as well. So we're clearly in a situation on the daily chart where there could be a lot of resistance around this level. What I would look for is a clear move either way, and at this point it's just too early to tell. But the overall trend is down, as you can see just looking at that trend line. So that's going to wrap it up for the first webinar. I know that I will be conducting a premium webinar in a half an hour, so if you're not a premium member, I'm sure that FX Street can let you know how to get set up as a premium member. As a premium member, we're going to talk a little bit more about interpreting the indicators that we've discussed in live market conditions and look at some live markets as well. So I want to thank FX Street for having me. I hope you enjoyed the webinar. And hey, if you have any questions, don't hesitate to shoot me over an email, support@rockbulltrading.com. And I hope I see most of you stick around for the premium user webinar because we're going to have a great time. Take care, everyone.